Hi everyone, this is Professor Gallagher, and in Chapter 7 we're going to talk about sales of property and the capital gains that are associated with those sales. The first thing that we're going to go over are some of the terms that are associated with sales of property. The basis of a property that's purchased is the cost of the asset, including cash, any debt obligations, and other property or services that are included in the cost of acquiring the asset. The basis of an asset that's transferred by inheritance, those assets are going to be valued at the fair market value of the property at the date of the death of the original owner, or the fair market value on the alternative valuation date if an estate return is being filed and the estate income is reduced by the valuation. If a property is transferred to a taxpayer from a spouse or a former spouse as part of a divorce settlement, the basis of that property is going to be the same as the spouse's or the former spouse's adjusted basis before the transfer. Any assets that are transferred by gift can be valued at the fair market value or basis of the donor, depending on if the fair market value is less than, equal to, or greater than the basis. So we're going to go through an example of that later. The adjusted basis is the cost of the asset less any accumulated depreciation of a business asset. The difference between the amount realized from the sale and the adjusted basis of the asset, if the amount realized is greater than the adjusted basis, then there'll be a gain on the sale of that asset. If the amount realized is less than the adjusted basis, then there'll be a loss on the asset. The nature of reporting taxes for gains and losses depends on the sale of a property, depends primarily on the use of the asset rather than on the asset form. So let's take it, for example, an automobile. This can be considered ordinary property if it's part of a car dealership's inventory and it's used just through the normal process of a car dealership's business. It could be considered a capital asset if it's owned by an individual as a personal use asset, or it could be considered a business use, a Section 1231 asset, if it is owned and depreciated by a sole proprietorship in their business. So the tax forms that we're going to use for reporting sales of assets are Form 4797. This is for sales of business property. We're going to use this form to report any or all gains or losses from the sale or liquidation of business property. This has four parts to it and is very detailed to include all types of possible situations that could involve property that's used in a business. Another form that is used for sales of fixed assets, is Schedule D. This is the form for your capital gains and losses. This is going to be used to report any or all capital gains or losses from the sale of a property that's held for investment purposes. Form 8949 is a record of the transactions. That form can also be used when filing your taxes for asset sales. So now we're going to discuss the different types of assets and how they will be taxed. First, we're going to talk about an ordinary asset. An ordinary asset is any asset that is not a capital asset. So typically these are assets that are used for business purposes. Like in our example with the automobile, it'd be an automobile that's held for a car dealership's inventory. Next, we have capital assets. Those are Section 1221 assets. Those are any assets that are used for personal purposes or personal investment. There are 8 exceptions to this definition, but we're not going to cover them all for this class. Typically, these will be an asset that is owned by an individual for personal use. Next, we have 1231 assets. These are business use assets, and they are depreciable or non-depreciable property that's used in a trade or business, and they're typically held for more than 1 year. Any business asset that's disposed of within 1 year of acquisition would be considered an ordinary income asset and would be taxed to the taxpayer at their ordinary tax rates. To go back to the ordinary assets, business inventory and accounts receivable are considered ordinary income assets. However, if they are sold outside of, not part of the normal course of business, the sale can produce an ordinary gain or loss situation. Sale of business property that's held for less than 1 year, the gains are going to be taxed at the taxpayer's regular tax rate, and there is no preferential tax treatment. Losses for ordinary use assets would be fully deductible. The tax treatment for capital assets is going to depend on the holding period of the asset. The asset must be held for more than 1 year for preferential tax treatment. The exceptions for this is any property that is received through a gift or non-taxable exchange, which we're going to talk about later in Chapter 12, generally has the same holding period as the transfer. Property that's acquired through an inheritance is always considered long-term property. The long-term capital gains rates are going to be 0, 15, or 20% for most capital assets, and there is a table, table 7-4 on page 7-10 of your textbook that explains the different AGI groupings for those tax rates. There is a 25% rate for depreciable real property that's used in a trade or business under Section 1250, which we're going to get to later. And there's also a 28% rate for collectibles and gains on Section 1202, which is small business stock, qualified small business stock property. So these are stocks from companies that are designated as small businesses by the IRS, and there is a preferential treatment on those. 50% of your gain is excluded, and then 50% is taxed at 28%. We'll take a look at an example of that later. For capital assets, if we have multiple gains or losses within a year, all of your short-term gains and losses are going to be netted, and all your long-term gains and losses are going to be netted. The gain or loss that is a result of the netting process will determine the deductibility of a loss and the tax rate that's used for that gain. The short-term, long-term losses, only $3,000 of the loss is going to be deductible against other income in any year. Any excess loss above the $3,000 is going to be carried forward and will retain their characteristics of either long-term or short-term. So let's look at an example. In 2005, Dunkin' purchased 2,000 shares of stock for $50,000 in a mid-sized local company with gross assets of $15 million. In 2018, Dunkin' sold the stock for $68,000. This meets the qualifications as a Section 1202, a qualified small business stock gain. How is this gain going to be treated for tax purposes? Well, first of all, we need to find out what the realized gain would be. So the gain would be the sale price, the $68,000, minus $50,000, which will give us a realized gain of $18,000. So since this qualifies as a qualified small business stock transaction under Section 1202, 50% of that gain is going to be excluded. So $9,000 is going to be excluded from tax, and then 50%, $9,000 is going to be taxed at 28%. So individuals are also subject to the 3.8% Medicare surtax if they have net investment income and also have modified adjusted gross income over the following thresholds. So the following thresholds are modified adjusted gross income over $250,000 for married filing jointly taxpayers or qualifying widower, or $200,000 for single or head of household. And if a taxpayer is married filing separately, the threshold is $125,000. So the Medicare surtax is going to be imposed on the lesser of either the net investment income for the year or the modified AGI over the threshold amounts. So let's take a look at an example. We have Naveen and Mari. They're married filing jointly, and they have $375,000 in modified adjusted gross income and $80,000 of net investment income. What amount of a surtax will they pay? So they're going to pay the lesser of their net investment income of $80,000 or their modified adjusted gross income of $375,000 minus the threshold amount for married filing jointly of $250,000, which gives us $125,000. So they're going to pay the lesser of either $80,000 or $125,000, subject to the surtax, which is 3.8%. So $80,000 is less, so we're going to multiply the surtax of 3.8% times $80,000 to give us a surtax of $3,040.